Welcome back to the channel. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called the Chaikin Volatility Cycle Reversal. This is a volatility-driven, mean reversion approach built on Chaikin volatility, a range-based gauge that measures how fast a market's high-to-low spread is expanding or contracting. Over the next few minutes, you'll learn how the strategy reads that volatility cycle, how it decides where a decline may be quietly bottoming and where an advance may be climaxing, and how it manages every trade with an ATR-based stop and a reward-to-risk target. Let's dig in, purely for education. Let's set the stage. Most volatility tools treat expansion and contraction the same way, but this strategy is built around an observation that Mark Chaikin made decades ago. Volatility behaves asymmetrically at turning points. Selling exhaustion at a market bottom tends to be quiet. The range dries up, the candles get small, and apathy sets in. A market top, by contrast, tends to be loud. The range balloons as the final wave of buyers piles in and the move goes climactic. This EA tries to trade both of those transitions, but with deliberately different rules for each side. The engine behind it is Chaikin volatility. The strategy takes each bar's high minus low, which is simply its range, smooths that range with an exponential moving average, and then measures the percentage rate of change of that smooth spread over a look-back window. When the smooth spread is shrinking, Chaikin volatility reads low. When it's growing, it reads high. Importantly, this is a range-based gauge only. It uses no volume at all, which makes it well suited to the foreign exchange market, where true traded volume isn't reliably available. To make low and high meaningful across different symbols and timeframes, the strategy converts Chaikin volatility into a z-score over a configurable lookback. A z-score simply tells you how many standard deviations the current reading sits from its own recent average, so the same threshold works whether you're on a fast chart or a slow one. This is a single timeframe system. It runs on whatever chart period you attach it to, and it acts once per completed bar rather than on every tick. In terms of who it suits, this is an educational study for traders who are curious about volatility cycle analysis and countertrend timing. It is not a recommendation and not financial advice. Every strategy, including this one, carries real risk, and losing trades are a normal part of trading. Here's the full decision process, step by step. On every completed bar, the EA rebuilds its Chaikin volatility history, then standardizes the newest reading into a z-score over the look-back window, which by default is 60 bars. It also reads 3 supporting values, a fast exponential moving average with a default period of 8, a slow baseline moving average with a default period of 50, and the average true range over 14 bars for sizing the stop. Now the long side. Remember, bottoms form quietly, so a buy requires 3 things to line up. First, the volatility condition. The Chaikin volatility z-score must sit at or below the negative threshold, which defaults to negative 1.2. That signals an unusual contraction, the market going quiet. Second, the context. The just closed bar must still be trading below the slow baseline, confirming a genuine decline is in play, so we're buying weakness, not chasing strength. Third, the trigger. The prior bar closed at or below the fast-EMA, and the just closed bar closed back above it, with a bullish body where close is above open. That reclaim is the first hint the down move is turning up out of the lull. When all 3 align, the EA signals a long entry. The short side is the mirror image in structure, but not in behavior, because tops are loud. A sell requires the z-score at or above the positive threshold, a genuine volatility expansion or blow-off. The just closed bar must be trading above the baseline, confirming a real advance. And the trigger flips. The prior bar closed at or above the fast-EMA, the just closed bar closed back below it, with a bearish body. That loss of the fast-EMA during a climax is the sign the move is rolling over. When those align, the EA signals a short. Risk management is identical on both sides. The stop distance is the ATR multiplied by the stop multiplier, which defaults to 1.8, and it's never allowed to be tighter than the broker's minimum stop distance. For a long, the stop sits below entry and the take profit sits above it, set at the reward-to-risk ratio, defaulting to 2 times that stop distance. For a short, the stop sits above and the target below. The EA holds only one position per magic number at a time, and it snaps order volume to the symbol's allowed limits. So the whole cycle is detect the volatility extreme, confirm the context, wait for the EMA turn, then define risk before the trade is even placed. Let's read the actual MetaTrader code. At the top are the inputs. EMA-period smooths the high-low spread, Volrock period is the rate of change lookback, and CV lookback, defaulting to 60, is the window that turns Chaikin volatility into a z-score. CvZThreshold, at 1.2, is how many standard deviations from the mean count as an extreme. Price-EMA-period is the fast-EMA at 8, BaselinePeriod is the slow baseline at 50, and then AtrPeriod, AtrStopMult, and reward-risk ratio govern risk. Next come the two trigger helpers. Reclaim up is true when the prior bar closed at or below the fast EMA, and the just closed bar closed back above it. Breakdown is the exact opposite, prior bar at or above, just closed bar below. Now the two signal blocks. Long setup fires only when all four parts are true. The volatility z-score is at or below negative CvZThreshold. Price is still under the baseline. We have a reclaim up, and the body is bullish. Short setup fires when the z-score is at or above the positive threshold. Price is above the baseline. We have a breakdown, and the body is bearish. Finally, the orders. On a buy, the code reads the ask, places the stop-loss 1 risk distance below, sets the take profit at reward-risk ratio times that risk above, and calls trade.buy. On a sell, it reads the bid, puts the stop 1 risk distance above, the target the same multiple below, and calls trade.sell. Same risk framework, mirrored direction. That's the whole engine. Let's walk this illustration candle by candle, taking a long trade first and then a short. On the price chart, you can see two overlays, the blue fast EMA that hugs price, and the gray slow baseline that moves more slowly. Below, in the subpanel, is the Chaikin volatility z-score, with a green contraction zone below -1.2 and a red expansion zone above +1.2. Look at the first few candles. Price is drifting lower, and the candles are shrinking. The first bar has a decent range, the second a little less, and by the third and fourth the ranges are quite small. That contraction is exactly what the strategy is built to notice. Watch the gold line in the subpanel. As the spread dries up, the z-score slides down and pushes into the green contraction zone, dropping below -1.2. This is the quiet, apathetic exhaustion that often marks a selling climax burning out. But contraction alone is not a signal. Notice that through this whole decline, price stays below the gray baseline, confirming a genuine down move is in play. That's the context the strategy demands before it will consider buying. Now look at the fourth candle. Price had been closing at or under the blue fast EMA, and on this bar it closes back above it with a bullish body, close above open. That's the reclaim. Volatility is contracted, price is under the baseline, and the bar turns up through the fast EMA. All three conditions align, and the buy entry marker fires. The stop loss is placed a set ATR distance below entry, and the take profit sits at twice that distance, our reward to risk of 2 to 1. From there, price lifts off the quiet base. The fifth candle pushes higher, and on the sixth candle price reaches the take profit target, closing the long. Notice the z-score has climbed back toward the middle as the range normalized. That's a clean mean reversion sequence. By the contraction turn, exit into the recovery. Now the market keeps advancing, and the character changes completely. Price is now well above the gray baseline, so a genuine up move is in play. Watch the 7th and 8th candles. Their ranges balloon. The 8th is a wide, climactic bar, and in the subpanel the gold z-score spikes hard into the red expansion zone, above +1.2. This is the loud, crowded blow-off the strategy watches for at tops. Then comes the 9th candle. Price had been riding above the blue fast EMA, and on this bar it closes back below it with a bearish body, close under open. That's the breakdown, the climax rolling over. Volatility expanded, price above the baseline, and the fast EMA lost. The sell entry marker fires. The stop loss goes above entry, and the take profit sits at twice the risk below. Price then rolls lower across the 10th candle, and on the 11th it reaches the take profit target, closing the short. Two trades, two different volatility signatures, buying a quiet bottom, fading a loud top. So that's the Chaikin Volatility Cycle Reversal. We covered how it builds Chaikin volatility from the high-low spread, how the z-score self-scales what counts as unusually low or high, and how its asymmetric logic buys quiet, contracting bottoms while fading loud, expanding tops, all confirmed by the baseline context and a fast EMA turn, and all managed with an ATR stop and a reward-to-risk target. Remember, this video is educational information only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries real risk, and losses are a normal part of trading. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like me to break down next, and subscribe for more MetaTrader 5 studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.